The best way to understand hedge funds, I think, is to go back to what you've already understood about investments in the stock market. When you give money to a fund manager, he invests it in, say, the FTSE 100, and the return you get is a mixture of the market going up and down, plus or minus the manager's skill. So most of your return is probably going to be determined by the market, and a little bit of that is going to be the manager's skill. Hopefully that's an added amount. What a hedge fund does is say, well, forget the market, let's suppose you just buy the manager's skill. So it doesn't matter whether the market goes up or down, it doesn't matter whether there's a good year or a bad year for the stock market. All that matters is whether the manager is skillful. There are lots of different types of hedge funds and different types of names, but we can group them into sort of three areas. The first is what might be called global macro, and this funny term CTAs. That's one group. Then we've got equity long short, and the third one we might call credit or relative value funds. There are lots of others, but these are the three ones that trustees are most likely to come across. A global macro and a CTA fund is first of all defined by what they invest in. And these are the funds that invest in the most liquid markets in the world, which are the overall stock market index, the overall bond market index, the exchange rates of the major currencies. Equity long short, which is now the biggest category of hedge funds, is in a way the easiest to understand for a pension fund trustee who's used to traditional investments. In the same way as their traditional fund manager will be overweight a share, a company, or underweight a share or a company, the long short equity manager is long that share or short that share, short simply meaning underweight. But instead of simply not owning a share, they can actually sell it. The motivation for this is to profit from the share price of a company going down. Now, how do you do that? I find somebody who owns the shares in a company, call it Royal Bank of Scotland, and I borrow those shares from that person. And let's say the share price is £2 and I borrow 1 million shares. I sell them, so I get £2 million. And I've got to give them back to the ultimate owner of these shares in a few days. So I sit there having sold them, I cross my fingers and hope that the share price goes down. Now let's suppose that the share price goes down from £2 to £1.20. Well, I've made £2 million from selling the shares already. I've got that in my pocket. I have to buy back those million shares, but its share price is £1.20. It's only going to cost me £1.2 million. So I give the shares back to the ultimate owner. It's cost me £1.2 million. I've made £2 million. The net profit is £800,000. Once you move away from the long short equity funds or the global macro CTA funds, you start getting into areas that include assets that are not in the area that pension funds normally invest in. They're not in the area that consultants normally consult about. And they are very often funds that consultants will say, well, I'm sorry, I just don't know about this mortgage-backed securities fund or this private lending fund to Argentinian ranchers. I just don't have the ability to assess these. And most consultants have said, don't invest. And to be honest, I think that's been good advice. There's a kind of intermediate category of which the most easy one is our credit funds, which again are very similar to the kind of funds that traditional investors will have begun to invest in, corporate bond funds. Again, the difference is that as well as being long, instead of owning the credits they like, they can actually go short against the credits they don't like. So it's exactly the same distinction that we had with the long-short equity funds. The standard three-liners on hedge funds would be they're private pools of capital, lightly regulated, high risk. It's interesting that people say hedge funds are unregulated. Actually, we're regulated by the Financial Services Authority, the FSA. There's a hedge fund standards board that we've signed up to. We have very strict rules about how we operate, which are in our prospectus. What the Hedge Fund Standards Board has set out to do is to sort of give a kite mark, a quality stamp, that providing you meet pretty standard criteria, then you get approved. And they're basically pretty simple things to make sure you treat all your clients equally, to make sure that there is a proper separation between the trading function and the risk management function, that the operations is properly set up, that you have an independent fund administrator. You know, I deal in large amounts of money with my fund. That's what a hedge fund does, but I don't actually have ownership of that myself. It's all taken care of by the prime broker and the fund administrator. It's a very interesting question about the impact of the credit crisis on hedge funds. First of all, the numbers. There's been big outflows from hedge funds. A lot of people redeemed. A lot of people were very disappointed with the performance of hedge funds. The stock market went down, but they kind of felt they expected that. Large groups of hedge funds went down together, and they weren't supposed to do that. And even worse, they went down when the stock market went down. What actually had happened in the hedge fund industry is I think they started off with a good idea, but they wandered down a road they shouldn't have done. And they wandered down that road in two ways. First of all, they started investing in all this stuff that wasn't very liquid, wasn't very transparent, wasn't easy to trade. And the reason they did that is they got paid for it. So they actually took your liquid money, put it in a fund and bought illiquid stuff. And that return, which looked like manager's skill, was basically being paid for illiquidity. And that's fine when those margins are narrowing and they have to gear up more and the returns are good. When you try and get out, you discover you can't. So I think that model of investing has its merits, but it shouldn't have a hedge fund type structure. It's much more suitable to private equity, where you put your money in, you know you're not going to get it out for years, and you only get paid when they realize the profits. The other thing that happened was we had a long bull run in the stock market. And a lot of hedge funds actually sat there basically being long the stock market. In other words, their returns, which were supposed to be separate from the stock market, increasingly came to be tracking the stock market. Now, that's what happens with a traditional fund manager, and his fees reflect the fact that a lot of what he's doing is just following the stock market. The fees for hedge funds are much higher, and they need to reflect manager skill. It's no good. You don't want to pay a guy for owning the stock market. And again, that's already changed. So you won't find hedge funds going up and down with the stock market like they used to in 2006 and 2007, because that's proven to be a bad approach. So my opinion is that hedge funds, which are still a massive sector, a huge sector in the industry, grew too far, went into areas they shouldn't, have gone back to their roots, and to be honest, that's where they should stay. So I think the challenge to the hedge fund industry from frankly lousy performance last year, which again wasn't our firm, but you know, the industry as a whole, that's fine. I mean, assets prices go up and down. I think that people are much less willing to forgive the Madoff scandal. And that was important because they were a very big, and many people thought very reputable firm, in which some of the leading fund of funds who are supposed to be experts in picking hedge funds put their clients' money. I'll just say a couple of things about that. Bernie Madoff did not have an independent administrator. It was his relative, wasn't it? I cannot imagine a British consulting firm letting any pension fund invest in anybody without an independent fund administrator. They wouldn't do it in long only, and they sure as heck aren't going to do it with a hedge fund. What an independent fund administrator does, by the way, is two things. First of all, he makes sure the assets are there. Secondly, he makes sure that fund is worth what it's worth. That's their job. The second thing is the rate of returns he was getting for the risk he was taking were just implausible. That well-known investment principle, you don't get out for nout, translated into financial jargon means in order to get return, you have to take risk. What Bernie Madoff was doing was printing 1% a month, 1.5% a month, 0.6% a month. I think his worst month was small down. Now, you can't do that unless you put your money in the bank. And he obviously wasn't doing that. So you cannot generate double-digit returns with a very smooth profile. Not over years. It just is impossible. So, in a sense, assessing an investor who invests in very straightforward markets is all about whether the fabric of the building is correct, whether the people there know what they're doing and whether he trusts them. And the same rules of thumb that he would apply to traditional fund managers: has staff turnover been good? Have they got a sensible compensation policy? Are people looking stable? Have they got enough money? All those sort of things. If they're positive, he's going to give them a tick. If people are leaving, if the assets are flowing out the door, if there are all kinds of conflicts, if they're moving too much, starting too many new funds, those are all warning signs that would apply to any hedge fund. You should see, in my opinion, hedge funds as investors who just do it in a different way, rather than people who've discovered some new way of making gold from base metal. They couldn't do that in the Middle Ages, and you can't do it today.